Options may be a suitable choice for you if you want to diversify your portfolio beyond stocks, mutual funds, and bonds. Diversification comes in the form of possibilities you get to have when considering options. While the risks can be significant, the profits can be as well. You may have heard that getting started with options trading is tough, or that it is only for experienced traders. Options are, in fact, something that almost any investor can try if they have the necessary knowledge. Do you want to jump on the options trading bandwagon? Here's an overview of options trading that cuts through the jargon and gets to the heart of this flexible investment strategy. But before we jump in action and start working on today's topic, please don't forget to subscribe to our channel, as well as activating the notification bell to stay updated with new content. And now, let's get started. What is options trading? Trading options may appear to be more difficult than it is. If you're seeking a quick definition of options trading, it goes like this. The trading of instruments that provide you the right to purchase or sell a certain investment on a specific date at a specific price is known as options trading. A contract that is connected to an underlying asset, such as a stock or other securities, is known as an option. Options contracts are valid for a specific length of time, which could be as little as a day or as long as a few years. When you buy an option, you have the right to trade the underlying asset, but you're not obligated to. If you decide to do so, that's called exercising the option. It's easier to comprehend what options are by comparing them to stocks. When you buy stock, you're purchasing a share in that corporation. You believe the company will continue to develop and profit in the future, and that its stock price will climb. If this occurs, you can profitably sell the shares. An option, on the other hand, is just a contract that gives you the right to buy or sell a stock or other underlying security, usually in bundles of 100, at a pre-negotiated price by a certain date. However, when that date arrives, you're not obligated to buy or sell a stock. You have the option to let the contract expire, hence the name. However, when buying options, you'll pay what's known as a premium upfront, which you'll lose if you let the contract expire. It's crucial to note that options are available for a variety of securities, but this article focuses on stock options. There are two sorts of options contracts. One is a call option, and the other is a put option. Call options. A call option gives you the right to buy a company's stock for a specific price, known as the strike price, within a specific time period, referred to as its expiration. Put options. A put option gives you the right to sell a company's stock at an agreed-upon strike price before its expiration. Once you buy the contract, a few things can happen from the time you purchase it to the time of expiration. You can exercise the option, meaning you'll buy or sell shares of the stock at the strike price. Sell a contract to another investor. Let the contract expire and walk away with no further financial obligation. Why do investors trade options? Investors use options for different reasons. Buying an option means taking control of more shares than if you bought the stock outright with the same amount of money. Options are a form of leverage, offering magnified returns. An option gives an investor time to see how things play out. An option protects investors from downside risk by locking in the price without the obligation to buy. But what are the risks? You can lose your entire investment in a relatively short period. It can get a lot more complicated than buying stocks. You have to know what you're doing. With certain types of options trades, it's possible to lose more than your initial investment. Example of a call option. Let's say a company's stock is currently $50 per share. You could buy a call option to buy the stock at $50, the strike price, that expires in 6 months, for a premium of $5. Premiums are assessed per share, so this call option would cost $500, $5 premium multiplied by 100 shares. Note that when buying options, you'll choose from an available list of strike prices, and it doesn't have to be the same as the current stock price. If the stock price remains at or drops below $50 during the 6-month period and never recovers, you could let the contract expire worthlessly, and your total loss would be the $500 you spent on the premium. That $500 is also the maximum amount you could lose on the investment. Now, let's say the price rises to $60. You could exercise your option to buy the 100 shares at the strike price of $50, then turn around and sell them at $60. In this instance, your return on investment would be $500. It would cost $5,000 to buy the shares, but you would sell them for $6,000 for a gain of $1,000. Subtract the cost of the premium, and you're left with a $500 profit. When buying a call option, there will be a break-even point at which you'll earn a profit. In this example, that break-even point is $55. So, if the stock is trading between $50 and $55, you would be able to recoup some of your investment, but it would still be for a loss. If the stock price rises above the strike price, the contract itself gains intrinsic value, and the price of the premium will rise accordingly. This means you could sell the contract to another investor before expiration for more than you bought it for, making a profit. You'll have to look at several factors to determine whether you should sell an options contract or exercise it. Put options serve a similar purpose as shorting a stock. Both let you profit if the stock price falls, but puts can also be used as a hedge against price drops that might hurt your portfolio. Let's say a company's stock is trading for $50, and you buy a put option with a strike price of $50, with a premium of $5 and an expiration of 6 months. The contract costs $500. If the stock price falls to $40, you could exercise your right to sell the stock at the $50 strike price. In this instance, you won't earn any profit, but you'll protect your shares from losing value. If the price rises, the contract will expire worthlessly, and you would be out a maximum of $500. In a sense, put options could be considered insurance for your stocks. If the stock price falls, you're insured to sell at the higher strike price. And if it rises, the premium you paid was the fixed cost of that insurance. But put options can be used for speculation, too, and you don't have to own the underlying stock to buy a put option. Let's say you bought the put option and the stock drops to $40, but you don't own it. You could buy the stock at $40, then turn around and sell it at $50. This would return a profit of $500. You would buy 100 shares at $40 for $4,000, then sell them at $50 for $5,000, generating $1,000. Subtract the $500 premium, and you earn $500. Like call options contracts, a put options contract can have intrinsic value. If the underlying stock price drops below the strike price, the contract will become more attractive, and the cost of its premium will rise accordingly. In this case, you could sell the contract to another investor for a profit. Risk versus return in options trading. Call options. If you believe a stock will rise, you may either buy the shares outright or purchase call options. However, there is a significant difference between the two. Notice how taking control of 100 shares of a $50 per share stock costs $500 in the example above. With the same $500 investment, you could only get 10 shares if you bought the stock outright. This is where options' return magnifying power comes into play, and why they're seen as a sort of leverage. We can see from the example above that if the stock price climbs to $60, the return is $500. You've doubled your money. If it rises to $70, though, your profit will increase to $1,500. What if it reaches $80? That's a return of $2,500 thanks to a 60% gain in the stock's price. If you had purchased the stock altogether, the same 60% price rise would have netted you a modest $300 profit. However, when there is a high likelihood of high gain, there is also a significant risk. If you'd invested $500 in the stock entirely, a small price drop wouldn't matter anything to you. A 10% drop, for example, would leave you with a $50 loss, and you could wait endlessly for the price to climb again before selling. Spending $500 on a call options contract, though, means a 10% drop in the stock price could render the contract worthless if the stock price falls below the strike price, and you have a limited amount of time for it to rise again. If it doesn't, that's a $500 loss or 100% of your investment. Put options. When buying put options, the maximum loss is the same as when buying call options. If the stock price climbs above the strike price, you'll let the contract expire and lose your entire $500 investment. The return magnification seen in call options, on the other hand, is reversed in put options. If the stock price falls to $30, you will profit $1,500. Profit would be $2,500 at $20. But this also means that put options have a profit ceiling. The stock can't go any lower than zero. When buying a call option, on the other hand, the profit potential is theoretically endless. Trading options can help you diversify your portfolio while also increasing your chances of making a profit. While you should be conscious of the risks, you should also be aware of the advantages that this form of trading can provide. You may swiftly expand your knowledge and leave your rookie status behind by easing into options trading. As we come here, we have reached the end of our video. We want to thank you for watching. Please don't forget to like the video and tell us what you think in the comments down below.